Welcome, everybody, to SEV Live. I'm the junior mining guy on Twitter and the CEO of the Soar Financial Group. Thank you so much for joining us. It is much appreciated. And we have another fantastic guest on the show today. He's European based. He's actually German. He's based in Switzerland, but we're going to speak English. Not going to be a German speaking interview, but maybe as a heads up, like I've tried it myself, it usually works quite well. YouTube offers a function where you can actually press CC and it offers you subtitles, and you can actually choose the language you want to listen or read the interview in. So that works quite well. So please go ahead and do that, because we're going to speak English. It's the international money language of money and policies, I guess. So we'll have to do that. And before I bring my guest on, it's Professor Dr. Torsten Dennin, by the way. He's an economics a professor for economics here in Germany, and also the CIO of Asset Management Switzerland AG. And we have some fantastic questions lined up, a conversation lined up about money, gold, Bitcoin, the recession and the recession versus commodities, energy versus monetary policies, and we're trying to squeeze that all into 25 minutes. So lots to discuss, and you know what? Follow us on YouTube, follow us on Twitter, hit that like and subscribe button if you love those conversations. We hope it's educational. That's the whole point. We hope you can broaden your horizon and just make better investment decisions in general. And we hope it's helpful. So leave a comment. We want to hear from you. And enough said. It's time to welcome Torsten here on the screen. It's great to see you again, my friend.
Thanks, Kai. Happy to be here again.
Yeah, the last we spoke was in May, so it's already been a while. Like, it was at our Deutsche Goldmesse here in Frankfurt. It's long overdue that we catch up, because a lot has happened over the last few months.
Exactly. Yeah, when you look cross assets, there's a lot of blood in the street, but you always see when there are lots of interesting opportunities looking forward as well, considering the right allocation and considering the right timing.
Yeah, absolutely. Let's talk about commodities in a recessionary environment. I think that's a really interesting topic, because you spoke in May. It's like, oh, the time of commodities is coming. We'll need it for the green energy revolution and everything. And since then, pretty much the copper price, for example, like Dr. Copper, one of the leading indicators for the economy, went from like $5 a pound to right now $3.45, $3.50 a pound. How are commodities impacted, and when will they turn around?
Yeah, looking at commodities as an asset class, I think most of the investors are very happy as long as we didn't put like one or two single commodities out of the basket. Because looking at end of August schedule for all the asset classes, you see equities down 20 to 30%, American market, Nasdaq 30% down. You see the bond market down 20%. You see real estate, not only the REITs down, you see also real estate prices coming down. You see gold down to 6% yet, in a 1 year horizon, and you see Bitcoin down 50%. So the only thing that is sticking out positively still is the commodity sector. So commodities measured by the Bloomberg Commodity Index or the S&P GSCI Commodity Index, so a little bit more energy weighted or like a broad diversified commodity basket, they're up 35 to 40% still. So there's the only diversification benefit for investors in 2022. So therefore, I stand with this thing that commodities are the place to be, even in this recessionary environment that we see today. Copper, you're right. Copper was a big retrace on that, but it was outpaced, for example, by the energy sector. When you see that net gas prices spiking, electricity prices spiking, and good old crude oil up and running.
Good old crude oil, absolutely. Definitely the one commodity we're desperately trying to replace, obviously, with copper and other like energy metals as well. As I said, copper down at 350, but with the energy revolution that we're trying to push through right now, like how much of recessionary pressure is weighing on Dr. Copper, and like how much forward looking is copper right now? I keep using it as a key indicator, by the way.
It's still in the role of a key indicator for the overall economy. And of course, the overall economy faces some serious threats in the moment based on the supply issues from key commodities from Russia, as well as from other regions in regard to the supply chain issues what we're facing. But this is like the energy, this is like some special materials as well. This is also a more European than like a global scheme on that one. Copper at 350 definitely in the long term is too cheap regard to that. And you see probably the last corporate action by Rio Tinto buying in Turquoise Hill a couple of, yeah, you can still say a couple of hours ago released on that. So copper and copper-related investments are still a very good place to be. But broad commodity exposure was a good place, not only in the beginning and first half of this year, but looking forward as well, because crude, we're trying to reduce it, we're trying to replace it through electronic energy revolution, for example. But of course, the oil age will not end by the lack of oil, as Saudi Arabia once put it.
Yeah, no, absolutely. And I don't think we'll ever get independent from oil. That's almost impossible. I think you mentioned in one of your presentations that like we're in an oil economy. Like what was the word you used? You used oil phonic? No, not oil phonic. You used the word in one of your presentations, if you remember.
Uh,
You know what I'm
um,
talking about, right? Because oil is in
yeah,
everything and all
yeah,
the
yeah. I think
plastics.
it was about the oil addiction, yeah, about the oil addiction of the world in regard to like compared to a drug addict, it's very hard to get out of the system on that. And to replace it will take a couple of decades, yes, and it will still be there, of course, in a lower stage.
No, absolutely. Like if you were to compare the commodity market with the broad market, and I keep coming back to copper, apologies, but Dr. Copper as a leading indicator of what is to come or what is happening, how much is reflected already in the main markets if you look at what where copper is trading, for example?
Yeah, in terms of a recession or like the cooling of the global economy, the metals reflected quite good, and that energy is in the basically in the penalty box. From the one side, you have lower demand from the overall economy in terms of activities, but of course you have much lower supply because of the tense situation in Ukraine and Russia. So therefore, it's a little bit between the sheets on that one. So looking at the overall economy, you see that the interest rates are rising. This is bad for risky assets. Future earnings are discounted much more deeply. So the net present values and the prices are impacted badly on the bond side, on the real estate side, and as well as on the equity side. The more growth oriented stocks were higher. So therefore, if you're thinking that the interest rate cycle, because of the overall economic situation, can't match the 1970s, for example, when interest rates have been like 10 to 15%, I think this is in our cycle with the level of debt we're talking about not possible. Then you see in several of these categories very interesting investment opportunities on the sides.
Oh, interesting. We need to go into depth on that. Of course, I want to learn more about like where I can put my money because I'm quite curious. Like in another conversation, it was the dividend-paying stocks that we talked about. But what are some of the other like asset classes that you would put your money in right now?
Yeah, I can make you like a private consultation on that one, just for like a friends of friends prices, for example, right? No problem on that.
Okay, fantastic. Now I'm just curious,
No,
like how to deal with a recession right now, like, or actually, are we even in a recession? Because I keep looking at it as like, and nobody really has a textbook explanation of what is happening right now, because we never had an environment where debt was so high, yet interest was somewhat low, and we were scared to raise it higher, right? Like,
mhm.
there's no textbook example of what to do right now, right?
And
So
that's making it more thrilling because if life would endlessly repeat itself, it wouldn't be like a surprise and it would be boring and it would probably bore you to death before you can allocate some money on that. But the textbook definition, basically, lots of people are looking first, of course, of the situation of the 1970s because you had like similarities, not only in bad clothing style and bad haircuts like in the Corona times, but also in terms of macroeconomic data like you have energy crisis, you have like a rising and high inflation, you have rising interest rates, and then you have impact on economic growth. Um, and that's called stagflation. Yeah, stagnation with inflation. And if you have a déjà vu now, it's intended, it's describing the 1970s and not the 2020s, but similarities are here. Of course, there are like a couple of things that are different, and this is interesting to watch. I mean, gold has a different status today it has in the 70s, coming from the background. As well, we have, for example, the crypto sector today. Not to mention that this is something we haven't had in the 70s as well. So different ways to allocate money, to see money, to rescue money. Also, the government stakes and the geopolitical situation is a bit different.
Absolutely. Yeah, it's very, very different. And I'm really interesting, like how the whole internet figures into all of this as well. Like the communication, how we communicate as well. Because I think that's a very different concept that weighs on people's minds as well, I think, right? Um, Interesting. Like we're talking lots of different things, and I think currencies are another one that sort of weigh on what is going on. The U.S. dollar is extremely strong, while the euro is extremely weak, based on the energy policies here in the EU. And how does that help the economies? Like I remember, Donald Trump saying, "Well, we need a weak U.S. dollar for our economy to boom, so we can bring in some more factories or bring more production back home." And to work on American soil and make it affordable, and we can use our own goods. Right now, we have the absolute opposite. We're trying to bring everything home, but nobody can afford it. Like, how does that look?
And everybody say, look, so fantastic opportunities now abroad with this currency situation. It definitely makes sense to put some money into emerging market or some other places. But the dollar strength, it's amazing. We face a bit of the same thing here in Switzerland, like the smaller brother on that. The Swiss franc also is very, very hard and very strong in regard to euro. So it's not only euro dollar that's on parity, but also like euro Swiss franc, it's on parity and below on that one. It's like a situation I haven't seen before. I'm now 10 years in Switzerland, and it's the first time I go with a car over to Germany to fuel my car because it's cheaper on that one. But vice versa, to see like people coming to Switzerland because now it's more cheap to come to buy here on the petrol station, especially after in Germany the Tankrabatt has been gone. And coming back to the US on that side, the dollar is on the move. The dollar is strong. The dollar is moving forward on that situation. I can clearly see the dollar probably another 10 to 15% increase against these currencies because the situation in Euroland with the Eastern Europe, with Russia and Ukraine, and some other issues of the European Union in the moment face severe difficulties on that. And also, it needs to be financed in a certain way. So the debt and inflation outlook, the macroeconomic data is a bit in unfavor of the euro. Hard to say, but it might be that we see like a euro, for example, dollar maybe to 0.885. Bad
That
for traveling to the US, right, Kai?
terrible, and I need to go next week, so I'm already dreading it. I love to go when it was dirt cheap, or even go to Canada when the exchange rate was €1 for $1.60 Canadian. That just made it so inexpensive to go. Now everybody's coming over here, right? It's I'm just trying to think what the implications are for the economies, right? Because if you're in the US manufacturing, you have to buy your supplies and commodities, which are now more expensive because you're buying them abroad, right? You have to import them. Um, I'm just trying to figure out how that whole construct is going to work because you want cheaper because you need to stabilize the economies, and that means raising your GDP. You want to reduce your debt. That means you need higher GDP as well. But it doesn't
Mhm.
work with those weak, like how do you call those? The currencies that are not behaving as they should, right? Because
Yeah, you had a good thesis in a book a couple of years ago called World War of Currencies on that one. Of course, like everybody is in competition to have the cheapest currency on that to boost economic growth. And now with the dollar that strong, I mean, it reflects also or contradicts the terms to source from home and to engage with supply chain issues that we were facing. Look at the chip industry, like the microchips on that one, building in the US, what you have basically in Asia. To be not that much dependent on Korea, Taiwan, and China anymore, or like uranium, another sector that you are facing supply chain issues that you would like to have for secure reasons some supply at home. It's getting more and more expensive on that, absolutely. So this is bumping economic growth on that one. This is the same bumps you see like globalization went a bit far on that. To have just-in-time delivery and very strict supply chain. Since Corona, we're trying to reduce it, and of course, this reduction comes to costs. The free dividend which we faced before is now reduced, and therefore economic growth will be impacted negatively. But this is like a phenomenon we see in the US, in Canada, as well as in Europe. A side effect is that Americans come to Europe. For example, I think 10% of Italian real estate um, selling nice villas at the Lago Maggiore and other fancy places are now from Americans, right? So Americans come to retire because it's dirt cheap in Europe.
Who would have thought, eh? Third world economies in Europe. Unbelievable. Unbelievable. But let's keep it real here for a second. Everybody, like leading banks are sort of forecasting double-digit inflation rates in the Eurozone, also in the UK. One bank even went as far as saying, well, we're going to have 22% inflation in the UK fairly soon. Because of the energy cost mostly contributing to that, of course, on top of labor cost. I asked you before, like, I think it's an interesting way to look at it is energy versus monetary policies. Like, how much can the monetary policies keep the energy policies in check or try to make up for the mistakes we're making on the energy policy side? Do you see like an equilibrium at some point? Because, as you said, we can't raise to 10% interest rates.
I mean, this is the target rates of the central banks reflecting in the market. That's for one. But mostly you need to see that this inflation is a bit different than the textbook inflation that we normally talk about. Like when we have like a demand-based inflation and the spiral between the wages and other costs in the economy, you have to raise interest rate to cool down economic activity that is too fast, too high, and then come back to equilibrium here. This situation we're in here is supply side driven. It is faced because oil and other energies and other materials are supplied at a lower level, therefore at a lower amount. Therefore, the prices are increasing, and therefore inflation is rising. But you can't only on the secondary side punish this situation with rising interest rates. It's like a double whammy. It's like cooling down the economy that was growing not so fast at all, and now with rising interest rates, basically you give it the death punch, on the sucker punch. I think it's not so much the commodity side here that is relevant and the energy that you have to conquer, but the debt bubble. Yeah, when in another interview we talked about that the global debt, the public debt bubble, doesn't matter if it's Corona, if it's a global financial crisis, is it green energy revolution, green bonds. Governments find always a different excuse in brackets to get into more debt, and this debt bubble is growing out of hand. And the growing out of hand debt bubble is only manageable with low to negative interest rates. So therefore, this thesis either limits the amount of interest rate hike that we can see in the future, because otherwise, first of all, governments of Spain, Italy, Portugal, Greece will face the first difficulties on that. They already would if European Central Bank wouldn't help them on the emergency buying side. But after this, also Germany and other more industrialized and developed countries will face more difficulties in supporting their social programs when an interest rates are too high, and you then need to service your debt positions. So I think the debt bubble that we see here is much higher level to conquer than the shorter term version of like the mismanagement of European energy politics.
Very interesting. Okay, how do you see everything playing out then? Like in the short to midterm as well. Like let's talk 6 months, but also 12 months. Like what do you see happening? And like they're called black swans for a reason. But do you see anything like do you have an idea what the black swan could be that brings the whole like bubble to burst?
Yeah, the first is the gray elephant on the energy side. I mean, this is hardly to overlook. The first effort is to come clearly through the winter, and most countries are trying to introduce taxes, special taxes on energy, windfall profit taxes to finance this on the side, to give money to the citizens to keep through the situation. First of all, the situation in the near term must be affordable, and second, energy must be supplied so that nobody is freezing to death in Europe. Right, it would be a catastrophe on that. To see like a region like this depending on natural gas and oil on that side. Looking further ahead, like 6 months, 12 months, and longer, I mean, we have a huge transition going on. Also, in regard to the target to be, for example, climate neutral European Union in 2050. So therefore, we have a lot of tracks to lead in the right direction. For example, looking at the metals market, look at the Dr. Copper again, looking at the smaller metal markets, and putting the tracks to the right developments. So you need to spend money now, and now you need to spend it in a smart way, and not for solving short-term problems of that. But the big elephant, no, that's not the gray one, but the big father office elephant, the big debt bubble on that. This is very hard to conquer, and I think I would like to quote here Mario Draghi, who said a while ago that nobody could be, like very freely translated, nobody can be fool enough to think that this money is ever paid back. It's just about how it's managed and how it's this debt situation is rolled forward.
Absolutely. Like I don't see any of the, let's say, Southern European countries paying us back, quite honestly. Like, although as Germans, I think I've read an article somewhere that we've been actually making money on lending money because we've been borrowing it from the EU for like 1% or some even lower, and been lending it to Greece and Italy for like 3%. So I think we've been arbitraging quite well there as Germans.
Yeah, true. When you look at 2010 and the sovereign debt crisis, that most of the exposure has been in France and in Germany anyhow. So rescuing Greek on the debt position was basically self-interest. But as my Canadian friends and business partner took it, I think the Germans are on that side at this level so in this Austrian policy. But the Germans are the only nation in Europe that is still thinking that German government debt somehow needs to be paid back at a certain while. So I think Italians are much more clever on that one because we realize it's not possible anyhow. And I think Germany will come to this conclusion, and maybe this is the dot what we are looking for the black elephant.
Yeah, good point actually, because I think Germany's debt to GDP ratio is only at 69%. I think it was below 70% last I checked, while the US is, I think, at 130. Japan is at 260, 270. That's quite high. So we got ways to go in Germany. We got some financial leverage. What do you think?
So in regard to Maastricht criteria, Germany needs to leave the European Union because the government debt is above the 60%, right?
I think so.
As
Yeah.
one of the most
Are we leaving yet? I don't know. We're having a referendum or something? No, I don't think so.
So, and to discuss if it would be better with or without. But anyhow, about the target money that all the other countries are owing to Germany, it wouldn't work anyhow. So basically, it's a community of countries with the same fate and with politics to sort things out. And for example, the goal to become climate neutral in 2050. If it's done in the right perception with setting the right tracks, it's a fantastic one, right? And it's needed that our planet faces the challenges looking at from climate change and other things.
Yeah. To sort of conclude here, maybe Torsten, and to put a bow around it, like how are you allocating assets now? Like in the next 6 months, like how are you protecting your portfolio, your clients' portfolios? Are you shifting money around into other asset classes that you hadn't done before? Are you looking into getting into new asset classes that you haven't owned? Really curious how you're playing the next few months here.
In a short answer, very, very careful, Kai. No, but to allocate money, my star sign is Libra, so I'm a balanced person. This reflects also in good diversification. You need different asset classes. You need different assets to counter the losses that you see in other asset classes. So the special situation in 2022 is that bonds and equities both are punished. So commodities are helping on that one. I think the precious metal is still a very cheap hedge looking forward. So in regard to that, I played very conservative, have still very low exposure to bonds. I'm not looking for increasing risks on the bond side to put too much money in emerging market or in high yields. But I think in the overall bond situation, government bonds are down 20% year to date, for example. It is interesting to start looking at European denominated bonds, because still if a currency goes another 10, 15%, I think there's a counter movement to that we see not only the 3.5% of running yields, but also maybe 10-15% on the currency side. And I trust here European currency more than some of the emerging market and local currencies. So that's about the bond side. I would have the exposure quite small. I see a little bit more interesting chances to counterweight the risks on the bond side on real estate still, especially in Switzerland, because prices are probably not rising that high, but they have like a briefer. But this briefer is not reflected in the performance of public traded real estate funds that are down like 15 to 20%. So this is a mismatch in perception of how high interest rates are coming to be. And on the equity side, I would be selective, looking at high dividend paying stocks on that one with industries that are not very much dependent on the economic cycle. On the one side, but on the other side, I would look at some of the techs that you're always looking at, because you want to have these fancy growth stocks like Amazon, Apple, and Co. But now they're starting to trade in the right direction at the right price, and this is something you don't have much. And of course, because we have like two focused areas: the precious metal and the crypto side. Cryptos is an emerging asset class that needs to be allocated at least at a small stage to portfolios. It's helping in the short run because of its high volatility and high return on the expected side. And the second, on the commodities, I mentioned gold as a hedge. It's cheap, but overall the commodities, you need to have a diversified investment in commodities. And as this was your first initial comment on that, it's not only copper. You need to have it all. You need to have energy. You need to have the metals and the agricultures.
Absolutely fantastic closing remarks there, Torsten. I really appreciate your time. It's great to have a professor of economics come on the program and explain to us a little bit what is going on and how to position yourself, and maybe what you see as the straw that breaks the camel's back here as well. And everything is so fragile. I'm expecting news every moment that the system is falling apart, to be honest. So sounds a bit doom and gloom, but there's so many factors weighing on our financial and economic systems right now that it feels like we could break any right? So
My pleasure, Kai. And it's good to talk like with substance and not in the usual greed and fear perception. Like, do it now or it will be too late, right?
exactly. Like no, like I'm not going to go there. But Torsten, you also got a couple books out. I know you have a couple copies sitting next to you, and you got a new book coming out in December, January as well in the winter.
Right, thanks for that one. No, I'm very glad Tulips to Bitcoin made it as an international bestseller now, being published first in Texas from the US version, now being translated into seven languages. The last one, I'm pretty proud to say, now also available in Chinese next to the Russian one. Um, Coming from this little fellow here. It's not only a super cover, but it's covering the development from commodity markets to strategic metals, to battery metals, but also to the crypto side. And in January, it will be my pleasure to also to introduce my new book. It's the fourth one. The title is, I haven't seen in the media yet, Games of Greed, and it's covering like white collar crimes cross through financial and the normal sector. Basically, Main Street to Wall Street, from Silicon Valley to Las Vegas, from rogue traders like Nick Leeson and Jerome Caviel to other frauds like Triple M Pyramid in Russia, to Operation Car Wash in Brazil, and to other scandals what we've seen recently, not only on Wall Street, but also on Main Street, to see the different phases of greed. I think it's highly entertaining on that one.
Games of Greed, White Collar Crimes. I think we found our YouTube title here, so we might have to use that. Fantastic, Torsten. Thank you so much. Really appreciate your time. I hope to see you in the fall at one of the many mining conferences that are happening here in Europe. And
Absolutely.
good to catch up. Thank you so much. and everybody else. Thank you so much for tuning in. This was SF Live. We were joined by Professor Dr. Torsten Dennin. He's a professor of economics and also the CIO of Asset Management Switzerland AG. Feel free to reach out to him anytime. I'll put a link to his website in the show notes here below. So if you feel like you need to either send some money to Switzerland or just want some solid investment advice from him, just make sure to reach out. He's fantastic. And make sure to follow us, of course, here on YouTube. Hit that like and subscribe button and leave a comment. What are you thinking is going to happen? What do you think is the straw that breaks the camel's back? Really curious to hear from you. And thanks so much for tuning in. And of course, we'll be back with more.